Hello, and welcome to another episode of ETF 360. I'm Kirsten Chang, Senior Industry Analyst at Vetify, and today I'm pleased to be joined by Bob Minter, Director of Investment Strategy on the ETF team at Aberdeen. He's here to give us his take on all things commodities. Bob, thanks so much for joining us today.
Thank you. It's a pleasure to be here, Kirsten.
Yeah, and what a time to be talking about gold. There's no question it's been the standout asset of 2025. I want to start there. First off, gold prices just hit $3,500 an ounce in intraday trading. So where to from here, and what's powering the rapid rise? Is it just a flight to safety?
It's really that second question there that it's just very frustrating because I hear things tied together, and you can't get the first part of that question correct without getting the how did we get here. And so what I see a lot of stories doing is taking two kind of headline worthy things and just connecting them. And that's really, really not what's going on here. This started way back after the 9/11 attacks in 2001. President Bush used special powers given to him by Congress to go after terrorist funding money. So that blocked people from using the US dollar trading system to settle some trades. And it was one of the first times that the US had used the US dollar trading system, the SWIFT system, as an arm of US foreign policy. President Obama used it in connection with Iran in order to get the JCPOA nuclear deal with Iran. Other presidents have used it to isolate North Korea from the financial system. Other presidents have used it to block the Venezuelan state oil company from issuing bonds. In 2022, President Biden cut off Russian banks after the invasion of Ukraine. So this has been an arm of US foreign policy for 25 years, using US dollar as an enforcer of policy. And so emerging market central banks got the plot. They understand that at some point they could get locked out of the US dollar trading system, and they needed to increase their gold reserves. So yes, it's very timely now. Trump and gold are in the headlines, but it's actually much deeper than that. And when you view it with that perspective, it's not going to end suddenly just because a different president comes in. So last 3 years, central banks bought over 1,000 tons of gold each year, and President Trump was not the president. So tying it to Trump is a little off. What is interesting to me is up until very recently, ETF investors have largely ignored this price rise. And they currently only hold about as many ounces as they did before COVID. And that's before a huge expansion of the Fed's balance sheet and a lot of spending when you normally would expect gold demand to rise. So from our perspective, this doesn't look like a very crowded trade. Additionally, some central banks are still buying. ETF investors started to buy in February, and they continue to buy, as well as Chinese insurance companies just received permission to add that to their portfolios, and they are doing that, and that's a longer term trade. So there's a couple elements here where we're not really too price sensitive on the demand side. And so that's the reason why even at $3,300 or $3,500 an ounce, we can say it doesn't really look that crowded to us.
Yeah, you make a lot of good points there. And how should investors think about owning gold miners versus owning bullion itself? What are the distinct differences to keep in mind?
So miners, the mining company equities, are theoretically a leveraged bet on the price of gold. And so right now, I mean, the average cost, all-in cost to pull gold out of the ground is $1,400-$1,500 an ounce. $3,500, $3,300. Those are record margins on every ounce. Frankly, why aren't the mining stocks higher? And the thing to remember is it still has equity exposure. And there are a number of things that even in our recent history that have happened that are very, very good for the price of gold, the metal, and very bad for the price of the gold miner, the equity. If you have bad management company who's misallocated resources at the company, great for gold, bad for the stock. If you have labor issues, if you have new union negotiations that raise the labor prices, the cost of labor, that's great for gold, bad for the stock. If you have to shut down a mine for COVID in the past or anything else, disruptions, protests, etc., that's great for gold, and it's really bad for the stock. So they are really two different things, even though you can see them sort of in the same neighborhood.
Yeah. Yeah. You mentioned the dollar earlier. As gold prices have soared, we've seen the US dollar on a downward spiral. Many on the street say it is further to fall from here. Is this the end of the dollar as we know it?
Is it a crazy question to say that? Is it just a headline clickbait question to ask that type of a question? The answer is no. We went back and looked at how long does a global reserve currency stay a global reserve currency. Before the dollar, it was the pound that lasted about 80, 100 years. Before that, it was the French franc. Before that, it was the Dutch gulden. Before that, it was the Spanish real de ocho. And I mean, I think we're back to like the 14 or 1500s now. But the pattern's kind of the same, where the country issuing the currency thinks it's invincible, and then it overextends itself either in a foreign war or too much debt, and then along comes a challenger. And you might have read a little bit. Really, just incredible author Graham Allison, who's a professor at Harvard, wrote a book about Thucydides' trap, which I'm sure I just butchered the pronunciation of, but it's basically when a rising power challenges an existing power. A lot of allegories to the U.S. and China. He happens to think it's cooperation and competition between China and the U.S. I guess we're going to see, but it's not a crazy question to ask this because we're right about 80, 100 years. There's some elements of this. We think we can do everything. We're not really worried about our debt, and the debt level is pretty high. So it is a privilege to be the country that issues the global reserve currency, and it's not infallible once you get that.
Yeah. No kidding. And just taking a step back, what are you looking for in the way of a viable bottom at this point?
Coming into January of this year, the S&P was famously at 23 times earnings on the PE ratio, really high. I mean, last seen when in the rebound from COVID and in the bubble of 2000, as if there were no rough waters ahead, and it just was really, for the situation, was extremely richly valued. And then you look at commodities, and it was one of the hated assets on Wall Street. Nobody's long it. No, even oil, nobody's long it. And so we thought, there's some adjustment that needs to be done in some of the asset classes, but commodities really isn't one of them. I mean, let's take the drill baby drill moniker that we heard about in December and November. That really, people forget that during the prior Trump presidency, he was really responsible for a drop of 2 million barrels a day in production from some of these fragile producers like Iran and Venezuela. And President Biden took office with a different set of priorities, lowering inflation. So he kind of looked the other way for those in enforcing those sanctions, because the bigger fish to fry was the inflation. So could we see a little stricter enforcement in the sanctions from Venezuela and from Iran? It's possible. It's very rare for money managers to not be hedged against the price of oil. Looking back through history, it's a relatively small amount that they have oil hedges on in their portfolios.
Yeah. And apart from gold and oil, are there any other commodities that investors are overlooking right now? I know you pay attention to silver very closely.
Let's assume the president has pushed as hard as he could in as many different directions as he possibly could, and he's able to gain ground in the areas he wants to, and he calls a truce, and we need to get on with the business of the global economy, and we start to settle things down. Well, then you take some of the negativity out on the global macro level, then you want the exposure to the industrial sector. And a great way to do that is industrial metals and silver, who have certainly not had anything like the run that gold has had. And so we think that's your turning point asset if things start to settle down and get more back to normal.
Okay. All right. That does it for ETF 360. My thanks again to Bob Minter for joining us. Bob, thanks so much.
Thank you, Kirsten.
And thank you all for tuning in. We'll see you next time right here on ETF 360.